Hi, Obi. Thanks for joining us from London.
Hi, Frank. Thank you for having me.
Obi, the interest rate is now back. What does this do to the precautionary behavior of people in general?
Well, Frank, I think yes. I mean, the interest rate environment we're experiencing higher interest rates around the world at the moment. But I would say the first thing is it's not all bad. Actually, for many people, this is just a return back to where we were maybe 10 years ago. So it's back to normal. For those people that have savings, all of a sudden you can get a higher rate on the savings that you have in your bank. The other good side of this is higher interest rates will eventually have the positive impact, which is what all central banks want, which is to control inflation. And inflation is essentially a tax on everybody. And then for us, myself and Mark, who run the Carmignac Grandchildren Fund, from an equity perspective, it allows us to be more selective and to benefit from the diversion between the good companies and the bad companies. So what we'll probably find over the next 3 to 6 months is we'll find there are more losers than we have seen over the last 10 years. And that's great for those of us who are stock pickers. Obviously, on the slightly negative side, higher borrowing costs mean less disposable income. There's a risk that some asset prices start to come down and there's going to be generally lower economic growth. But I think that problem is the biggest problem for those people who invest in equities that have too much leveraged or challenged business models. For us, it's actually an opportunity rather than anything else.
So let's turn to the Carmignac Portfolio Grandchildren. The fund is designed for long-term investors, including retirement savings. What is the USP?
Wow. So, I mean, I think before maybe I go into the USP, let's just, for full disclosure, and this will help you sort of see through my question. I mean, I am on my answer to the question. I have my entire family's long-term savings are in this strategy. So in the Carmignac Grandchildren Fund, that's my wife and I, who are both in our 40s, and my children who are at school age. We all have our money invested in this particular product and the particular strategy. And so even my pension's included in that as well. And so from that perspective, I think that the USPs for me are very clear. And let me give you what they are in maybe 3 bullet points. And first of all, we invest in equities in an unconstrained manner. So, we have benchmarks that we can follow, but we don't. So we prefer to take a direct approach when we come to investing. We only invest in high quality companies. That's one thing. That's companies that are very profitable. And we look for companies in particular that are looking to reinvest. So they have a better chance that when my daughters or my family need to take that money out in 20 years time, that these companies will actually be around. So that's the first thing. We look at unconstrained companies and we focus on high quality businesses. The second part is, we invest in companies that we believe will have the least negative impact on society. So we avoid certain parts of the market, and maybe we'll come on to that later. So parts of the investment market that might be fashionable at times, but actually we don't want to invest in them for ethical reasons. And we also try and invest in companies that we think will produce products and services that will generally benefit society. So that's the second part that I think is a unique selling point. The final part is, although we're long-term focused, I mean, we started off the discussion by talking about interest rates, and clearly interest rates, as I mentioned, will have their consequences on growth and so on. So we make sure that we're invested not in a vacuum. We know that the cycle can move around from year to year, and so we make sure that from a business cycle perspective, that we're investing in the right types of stocks within our investment universe, so that we're not so that we're managing risk accordingly. So those are the three key USPs.
What would you say? How does it differ from other products focusing on retirement planning?
So how does it differ, Frank? I think I think back to my younger days and how we were sort of taught the 101 of investing and how you should think about investing over the long term and how you should invest for retirement. It was all about taking risk at the beginning. So you buy emerging markets and you buy risky assets at the very beginning. And then when you get towards retirement age, you focus on income investing and you reduce the risk of your portfolio. And the last couple of years have been a good example where that actually has been a very tricky strategy, as actually some of those lower risk investments have become more volatile. So how do we differ? Our focus is on our investors growing their assets alongside the companies that we invest in. So we don't have a targeted return, although we expect to beat the broad benchmark or the broad market over a 3 to 5 year horizon. But our mission for our investors in the fund is, if we're able to find companies that can grow in a 5-year window, then it's more likely that they're likely to grow their assets alongside us. So the typical measures that we use are, if we can find a company that's growing around 15% a year in terms of its earnings, their profits double every 5 years. And that's the type of company that we'd like to invest in over a longer period of time. And I think that's the difference. We're trying to make sure our assets grow through time, regardless of the age of the investor that's investing in the product.
So the Carmignac Portfolio Grandchildren is a Article 9 fund. How does the fund reflect the ESG topic?
Yeah, so again, there's a couple of angles, and we may have gone through these a bit already. But there's two concepts. One is sort of do no harm. So we try to make sure that we do not invest in companies that are in certain parts of the market. So anything to do with fossil fuels, weapons manufacturing, gambling, tobacco, alcohol. We have exclusions where we will just not invest in those type of companies. That's the one side. The second side, actually, the Article 9 side, which is making sure that we're investing in companies that produce products and services that actually will benefit society. So you know about the United Nations Sustainable Development Goals. We target 9 of those, and we look at the revenues and the capital expenditures of companies. And if we can target companies which have aligned with those UN SDGs or United Nations Sustainable Development Goals, then we actually have a good way of explaining how not only are we investing in good, profitable businesses, but we're investing in businesses that are producing things that are positive for society as a whole.
For which target groups and for which investment horizon do you think it is suitable?
So, of course, I'm going to say the obvious, and I'm going to say everybody. I mean, I gave you at the very beginning an example. I mean, from my family's perspective, we're throughout the food chain. So we're from young to middle-aged, and I would even recommend this for those who are an older age. And if you look at the holdings that we have across our funds, they do represent that. So, the community as a whole, we don't all consume the same things. As we get to our older ages, we may be more focused on things such as healthcare, travel. But actually, for those consumers at a younger age, they're more interested in consumption or in tech. And so actually, if you look at the broad-based portfolio of companies that we own, they do tend to cross the spectrum of different types of investors. But the key thing is for investors who are really looking to grow wealth. And if you're patient and you're prepared to own a fund over a 3 to 5 year window, this is the type of fund that I think would be quite adequate for you.
The fund has been on the market since May 2019, I think. What has been the portfolio construction since then? And in terms of sectors?
Yeah, so the fund is just over 4 years old, so 4.5 years in age. We typically tend to focus on growthier sectors, so with a quality tilt. So there's a lot of exposure to sectors such as technology, to healthcare. Those tend to be the biggest sector bets. And then actually what tends to happen is we tend to have an underexposure to some of the sectors which have structural issues. So I call them the sectors that are really dependent on the economy around them to grow, whether that's the energy sector, whether that's the financial sector, industrial sectors. They're very, very GDP dependent. And so you'll see when you look at the types of holdings that we have in the fund, that we have a significant underrepresentation in those areas and an overrepresentation in the areas of the market where they tend to grow on their own steam.
Right. Thanks very much, Obi.
Thank you.